Okay, we are back. I'm very happy to have back on the Goldstein on Gelt show John O'Connor, who's the president and chief investment officer of 3D Asset Manager. If you missed the first time that I interviewed him, you can go to Goldstein on Gelt and just look at the archives, or simply go to YouTube and look up John O'Connor and Goldstein on Gelt, and you'll find a video there of the interview. John, real pleasure to have you back.
It's good to be back, Doug. Thank you.
Now, a lot of people talk to me in my day job as a financial advisor about the ongoing volatility of the market. And one of the things, I tell them is, some people trade volatility and they cherish volatility, but for normal people, they really don't like it. What kind of investment do you think is generally suited to normal people in a volatile market?
Well, first, I agree with you. Everybody likes volatility as long as the direction is up.
Right.
We have to remember volatility is a two-way street. I don't think there's any particular investment that is suitable for everyone in volatile markets. I think the best way to go, because everybody has different needs, everybody has different risk tolerances, is an investment strategy. And that's going to be different based on an individual's particular needs. And it may be aggressive, it may be conservative, but it should be managed, it should be watched over, because markets change, but so do individual needs and circumstances. So what we do is we typically try and keep people very diversified, around the globe in stocks, around the globe in bonds, real estate, other types of investment assets, possibly commodities, hedge funds, and other types of alternatives, all to try and manage the risk or manage the volatility of a portfolio. But like I say, it's going to depend on that individual investor's needs to really develop the strategy that will end up as a portfolio structure.
So you're not suggesting that someone try to anticipate volatility and then either move away or into something, but rather your advice is more to spread out the risk broadly enough so that volatility in any one sector is not going to do a lot of damage?
Well, right. There's no way really to predict volatility, especially in today's day and age with 24-hour news cycles and overreactions by both private and large institutional investors. So the best way is to assume volatility will be part of your investing future and diversify away as much of it as possible, and then also take a look at especially your time frame. If you're going to need money in the next year or two, it really doesn't belong, at least in large part, in the stock market. So keep it in something safe. If you don't need money for a long time, get aggressive with it.
So let's talk about that a little bit. Let's talk about the case where someone has money that he needs in the next year or two, like your example. And then he says, John, the interest rates are basically zero if I keep it in the bank. Aren't I losing money by keeping it there? Isn't there something I could be doing?
Well, if you keep it in the bank or in some sort of a certificate of deposit or money market fund, you're protecting yourself from the downside risk of the stock market. You're right. You're not protecting yourself against the ravages of inflation, but then you have to ask to yourself, what's more important to me, having the vast majority of my money available in 6 months or a year when I'm going to have it, versus taking a risk and having, if we see another 2007, 2008, a year could go by and the stock market could be down another 30%. So it's a question of your appetite for risk and how soon you'll need that money.
So let's reframe the question in terms of someone who is retired or close to retirement. The conventional wisdom is you should move more of your portfolio into bonds as you retire. But again, these days, people who are no longer getting fixed pensions from big organizations that they can count on, so that's off the table, they really do need some sort of income or some sort of return from their money. Yet, on the other hand, they're being told, well, you better not take too much risk because you're getting older now. What should they be doing?
Well, actually, this is one of my favorite topics because if somebody is retiring or newly retired and they're not planning on dropping dead in the next year, most people are living 20, 30, 40 years after they retire these days. There's no reason why some of that money can't still be aggressively invested. So what we see a lot of advisors do is segment somebody's retirement plan, post-retirement plan, retirement income plan, and the money that they'll be drawing for the next, say, 5 years or so, you want to keep that very safe in some kind of a guaranteed investment or non-volatile investment so that you're sure you're going to get that money on a monthly basis or quarterly basis. But the money that you're not going to have to touch for 25 or 30 years, that can be invested like anybody else would invest a 25 or 30-year time horizon investment, and that can be, largely diversified around in stock markets around the world. So it's almost like a reverse glide path. If you're familiar with target date funds used in 401ks that get more conservative the closer to retirement, once you retire, the farther out you go, the more aggressive you can afford to be.
Mm-hmm. We're talking with John O'Connor, a repeat guest on the Goldstein on Gelt show, and he's the president and chief investment officer of 3D Asset Manager. He's been talking to us about one of the most critical concepts in investing, which is diversification, but also realizing that if you're a long-term investor, then depending on your situation and your tolerance for risk, it might really be okay to have some exposure to the market. John, you mentioned something about the importance of having income, let's say, when you retire for the next 5 years or so. A lot of times people turn to annuities or other insurance products. Is that necessary in order to ensure your income?
It's not necessary. It is convenient, though, and if you're using an insurance company with a high quality rating, you can be sure that you're going to be getting that check every month or every quarter. If you feel comfortable laddering government bonds or laddering CDs or just putting your money in a money market fund, that's okay as well, because if you really look at the effect that a 1 or 2% internal rate of return has over a 5-year period, it's really negligible. It doesn't make a big difference in your standard of living.
So you're saying that the difference between what you might get from an annuity is not that much greater than if you simply kept the short-term money in the bank?
Right. Yeah, and because annuity rates, typically a single premium immediate annuity, which is the income type of annuity. If you buy a 5-year annuity today, I think the rates are only about 1%, 1 to 2%. So it's not going to, but it is going to be convenient. So, an annuity company will put the money in your checking account every month via ACH.
Okay, so let's drill into this a little bit more. Let's talk about for the side of the portfolio which is going to be aggressive. Let's assume that our Goldstein on Gelt listeners say, John O'Connor sounds pretty smart. Let me put my next 5 years of money into the money market, and they're comfortable with that. And then they say, but I want to have stock exposure, but of course I'm scared, so why don't I go for like a variable annuity? Does that make sense for a long-term investor?
Well, it's going to depend on, what type of financial professional they work with. Variable annuities certainly do have the ability to invest in stock markets and bond markets around the world. They allow you to segment to a degree your investments within. We don't use variable annuities here at 3D, but I know a lot of very competent financial professionals that do.
I see. So do you generally think that people should be managing their own money, learning a lot and trying to take care of it, or is it really better to turn it over to a third-party money manager?
Honestly, it's interesting. We've got a few advisors that work with us, and typically we only work through advisors that specialize in retirement income planning. And it's a different skill set than maybe the financial professional that's helped you accumulate wealth over your working years. It's a different set of tools, a different set of skills that a financial planner or financial professional uses to plan out the distribution phase of one's investment strategy. So I'm a big believer in hiring somebody to help you manage your money. I'm also a big believer in hiring somebody to help you change the oil in your car and fix your in-home electrical if it goes down. So you hire a pro.
I hear. I actually, taking that line of thought, in my day job as an investment advisor, really what I spend a lot of time doing is helping clients develop their financial plans. And quite frankly, that takes a big part of my day. And when people say to me, well, Doug, are you going to buy and sell the stocks in my portfolio? I tell them, no, I'm not going to do that. It's not that I don't know about it. It's not that I'm not licensed to do it. And I'm interested in the stock market. I enjoy following it. But there are money managers. All they do all day is watch the markets and develop strategies and trade the portfolios. And I explain to the clients that as an advisor, I'm able to serve them best by looking at different managers and selecting the ones that I think are going to do best for the clients, rather than trying to pretend that I have some sort of prophecy and that I really do have 8 hours a day to spend just trading the portfolio. Because that's what the money managers do. They're not out there dealing with clients and financial planning and retirement planning. And I think that's really a good model, the way you described it.
That's an excellent point. Just like probably any industry, you get specialists, and we're a specialist and you're a specialist that work well in concert with one another. So we don't do financial planning for individuals. We don't pick out insurance products. We don't talk about people's estates. All we do is manage portfolios. We tend to use ETFs within those portfolios. That's what we do all day long, every day of the year.
Mm-hmm. So in the last minute or so, just tell me, in your strategy, your investment strategy, why do you choose to use ETFs as opposed to, let's say, finding individual stocks?
We find that they're efficient, transparent, very, very liquid, and give us exposures to entire asset classes, and therefore get us halfway to the diversification that we're looking for, very, very economically. So for us, they're in investment of choice because of the exposure they give us to the global markets with a single click, in essence.
And I'll just mention for the Goldstein on Gelt listeners who live outside the United States, having a portfolio in ETFs with all the benefits that John was just mentioning has another benefit, which is if you're used to buying mutual funds, open-end mutual funds, you'll find once you have a non-U.S. address, oftentimes those funds no longer want to work with you. Whereas when you have an ETF portfolio, you can still benefit by having professional management from a company like 3D, and yet you don't have to have any concern that one day the mutual fund is going to say, wait a second, you live outside of the United States, we're going to bust your trade, or we're no longer going to keep you on as a client. John, we're just about out of time, but in the last few seconds now, tell us, how can people learn more about the work that you're doing?
Well, we've got a website. It's www.3dadvisor.com, or they can call you, and you can tell them more.
All right, that sounds fabulous. Once again, John O'Connor, a real pleasure to have you back on the show, and I look forward to hearing from you again soon.
Thank you so much. It's been great.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world, but if you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt Show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt Show.